comment on the trade data that just came out at 9 in the morning. Why is it that our exports are still in contraction mode, albeit of course lower than what was expected, especially since the peso's depreciation is supposed to benefit the sector? And also, what is happening with the higher than expected imports?
Well, number one, it was forecasted that it should be more than -4%. No? So we more or less we are somehow happy with a -2% performance of exports. That's more than expected. No? But at the same time, I think if you're a manufacturer slash exporter, it will take you time for you to actually repurpose or expand your production capacity and production numbers for you to absorb these depreciation levels. No? So the question for you as an exporter is, will this higher exchange rate environment persist over the next 6 months so that you will be able to plan your production appropriately? So I think with that, we can see at least another 2 to 3 months for our exporters to actually feel that particular confidence that they will be able to export more with a higher exchange rate. No? So I think those are good signs, those small, but those are better signs for our exports to perform better, especially that we are now facing the holiday seasons.
Sir, in terms of the trade deficit, which has ballooned and it's higher than expected, and also the imports, does this show signs of growth, capital formation? Are we using the imports to actually have investments here? Or is this worrying for you because this might just be linked again to oil prices, agricultural commodities?
Definitely, this is a sign. Remember that we had a ballooning trade deficit during the build program. So this is already a manifestation that once again the build now a build better more program is now kicking in, and so more or less we are importing a lot of these construction materials, and that's why construction materials prices are actually at its all-time high, and all these imports of capital equipment, of course, our general population is actually importing more because of higher labor data, and therefore they have income, and that they can actually buy more imported items. No? And that's why from the point of view of the exchange rate is reflecting this. No? So we are demanding more dollars, and therefore exchange rate is also going up. But as the exchange rate corrects in this particular situation, so we can have an equilibrium between exports and imports.
Okay, given that, more on that point, Prof, how do you see the peso at least performing in the near term? Should we be bracing now for a $60 to $80 level sooner rather than later?
Most probably, no. So since the inflation environment in the U.S. is still not normalizing, no? But it's slowing down, but it's still at very elevated levels, and so therefore we can very much anticipate an exchange rate that is more than 60, also in light of a very, very high trade deficit. So this particular exchange rate increase or a depreciation is a long time awaited correction because of our trade deficit. It should have happened a long time ago.
Okay, and in terms of that, how long is this inflationary environment set to persist? We had, again, another oil price hike after a series of rollbacks. And even the prices of oil back to jumping because of the OPEC plus cuts. How much worse is it going to get, Prof?
We cannot see an inflation going to 5% by the end of the year. No? So we can only expect it towards the middle of the first quarter next year in terms of our inflation going back to 5% and below. So that particular inflation numbers will remain above 5% towards over the next 5 to 6 months. But in a way, that is also being caused not just by oil, but actually a strong rebound of our economy, as we can see from the labor numbers, from the purchase managers index numbers. So our manufacturing is also performing very, very strongly. Our trade, tourism, and transport and logistics are also performing very strong. And therefore, this will produce an elevated demand environment that will further contribute to the demand push of our inflation.